down 67% in 2022. Is DoorDash stock a buy for 2023? Let's answer that question in this video, so stay tuned. The first thing I'm going to look at is DoorDash's revenue growth going back to the brief history we have with DoorDash until January of 2021. And you saw the phenomenal growth in 2021, over 180% in several quarters. And of course, that makes sense as people were stuck at home and in-person dining at restaurants was closed. Many people took to the platform to order food for delivery, and the company also signed on many restaurants who, if they wanted to continue making sales, needed to partner with a delivery service provider in order to continue operating. Otherwise, it needed to just deal with having zero revenue for the foreseeable future with the uncertain length of lockdowns. And so DoorDash thrived under those circumstances, growing revenue and adding millions of customers. However, what's been a surprise is that it's been able to grow even on top of that. There were fears among investors that once economies reopen, DoorDash's revenue growth would turn negative, but that hasn't been the case. It has, kind of bottomed here at about 30% growth over several quarters here in 2022 as economies have remained reopened. Next, let's look at its operating income. And what surprised me to see this is that even, I've been following this company for several years now, and I was surprised at how the company was not able to turn a profit even during those boom times in the pandemic when other restaurants were closed for in-person dining and its own business was exploding. It barely turned an operating profit, but for the most part, its operating income has been trending downward in the same direction, and it lost 308 million in its most recent quarter. It's a little bit troubling to see that it wasn't able to turn a profit even at these levels. But intuitively it makes sense when you look under the hood and you look at how much DoorDash pays each driver for each delivery, and then you look at what DoorDash charges the customer. You can understand why it just cannot turn a profit, because it needs to pay the driver per delivery, and it can only charge the customer, $4, $5, $6, or $7 at the most, because at a certain point, consumers are going to say, no, I'm not going to pay this fee for delivery. I'd rather just go out and pick it up, or I'm not going to order this meal at all. And then at the same time, DoorDash is sending out heavy amounts of promotion. I know those of you that are watching, if you're in the US, you've probably recalled getting an email from DoorDash in the last month or maybe even in the last week telling you, hey, order from us in the next few days and we'll give you 25% off your order, 40% off your order, 50% off your order, or maybe even more than that. I know I get multiple emails like that every month, and in fact, I won't order from DoorDash unless they send me that kind of promotion because I'm so used to getting them. I just wait for it before I order from DoorDash. And it's hard to see how this company can turn a profit in any time in the near future. Investors are hoping, maybe enthusiasts are hoping sometime in the very distant future at a scale so large it will turn a massive profit. I don't see it. So I'm not very bullish on this stock for now. Let's keep looking though. Let's see its cash flow from operations. At the very least, it's generating positive cash flow from operations, and this is moving in the right direction. So what this tells me is that the company is probably using a lot of stock-based compensation, and they're diluting shareholders tremendously. And so I've pulled that up on the next slide, and you can see massive shareholder dilution here from around 280 million average shares outstanding. They've gone to 380 million shares outstanding, 384 million shares outstanding. So they're paying out a lot of stock-based compensation. That's allowing them to be positive in the cash flow. However, it is diluting shareholders. So eventually, if they do end up turning a profit in the somewhere distant future, that earnings per share is going to be lower than it otherwise would have, because there's going to be so many shares outstanding at that time if it continues on this pace. So finally, let's look at its valuation. It's trading at a price to sales of 2.8. That's the cheapest the stock has traded for going back until January of 21. Of course, we don't have much longer history for DoorDash. It's a relatively new publicly traded company, so it's the cheapest that it's been in its brief history. However, to answer the question, is the stock a buy for 2023? I'm going to say no, it's not a buy for 2023. I want to see a little bit of evidence in how this company is going to turn a profit, because I don't see how that's going to happen if it needs to continue paying the drivers the fees that it has to pay them and only able to charge customers what it can charge them. I don't see how they're going to bridge that gap, and so for that reason, I'm going to say the stock is not a buy for 2023. All right, that's all I've got for this video. Thank you for watching as always, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.